Good morning once again, and welcome to the Haven Financial Group radio show. I'm Larry Kulvig, founder and CEO of the Haven Financial Group. Kyle Thomas on with us today, certified financial planner on the Haven investment team. Proudly celebrating our 10-year anniversary this year, Kim, as we've talked about, 10 years. By the way, we had some great educational classes from the local police department this past week, full classes on fraud and scammers and what to look for. And we continue to have those types of classes to assist the public and our clients and all those that can be negatively affected by this fraud that only seems to get worse. So again, thanks to the local police for coming in and teaching us on what we could expect out there and how to avoid some of these issues.
That's fantastic. 612-504-8400. That is the number for Haven Financial Group. If anything we're talking about today rings a bell and you'd like to get some questions answered, be sure you give them a call. Again, it's 612-504-8400. We're talking about inflation and the Fed's interest rate hikes. We want to talk about investment management principles for retirees. I think there's a lot of folks out there who are wondering, with inflation being high and interest rates being cut, what are the guidelines? What should I be doing? So maybe you guys could walk us through some of the principles that you invest with, and that maybe our listeners should be aware of, starting with balancing growth and protection.
Yeah, I think when most people think of investing, they picture the stock market, chasing returns, how to outsmart the market, timing the market, which all can be very dangerous. But when you're getting close to retirement or in retirement, I always say, offense is important, but defense wins championships. Coming up with a plan that has some stability, maybe some security, which doesn't mean becoming over conservative, but what we see in observation over many, many years is most people don't know how much risk they're taking. And again, it's not the same for everybody. It's not one glove fits all, but helping people understand, here's how much risk you have. Is that comfortable? What's your willingness for risk? Do you need to take a bunch of risk? You may have the ability to, but how do you answer those questions? Is principal protection, is that more important to you? I can think of I had a lady in this past week, and she was referred to us by a client. She's in the healthcare field. She's ran a variety of different nursing homes over many, many years. And she's single. She had no kids, very few beneficiaries, but she goes, Larry, at this stage of the game, I don't want to be taking a bunch of risk anymore. And it's not for us to tell her she should. She flat out said she didn't want to and she didn't need to. And whether it was intentional or not, she's done a great job saving for retirement to the degree that she could retire today and it wouldn't make one bit of difference. So again, it's really listening to the folks that we're sitting with, having an understanding of what they're trying to accomplish. Are they looking to double their portfolio? Are they looking to maintain their portfolio? And we want to be reasonable. I always say a lot of financial people like to puff up numbers, and that's, to me, just a waste of time. Let's be reasonable. Let's be practical in the types of returns that we're projecting. Of course, we all want the highest returns. But again, the market goes up and it goes down. So these are the conversations that we continually have throughout all the years of retirement, which we hope are many, many, many years.
Absolutely. We're talking about investment management principles for retirees. Larry just talking about balancing growth and protection, not being too conservative and yet not being too aggressive, and being realistic. Diversification is another term that you guys use all the time, and this has got to be an investment principle. You have to have a diversified portfolio in order to overcome the things that we're talking about: inflation, rate cuts, these kinds of things.
Absolutely. Diversification is one of the best ways that we mitigate risk. And like Larry mentioned, as we get into that retirement phase, we want to make sure that we aren't, overstretching ourselves. We don't want to be too aggressive, but we also don't want to be too conservative. So we want to have a nice mix there of stocks to bonds. But within each of those stocks and bonds categories, there's diversification that happens. So within the stocks, we want to make sure that we have large caps covered and different types of large caps. We want to make sure we have small caps covered and different types of small caps. Then we want to make sure we have international exposure and emerging markets and then real estate. And those are all important because they all act differently, especially at different times. This year, international is outpacing the United States stocks. So we want to make sure that we have some exposure to that as well. And we don't know when these different asset classes are going to be at the top or the best performers or the worst performers. So that's why we allocate to them all and actively rebalance. On the bond side, we have different types of bonds. We have short-term bonds. We have intermediate-term bonds. We have global bonds. We have TIPS. We mentioned Treasury inflation protected securities earlier. So we have these investments spread across different industries, different regions. And what that does is it reduces your overall risk because there's hundreds of investments inside each of these funds. And we're trying to not have any of these funds overlap with each other. That way you get a pure play in whatever kind of way we're trying to invest for each of those different styles of investments.
Of course, we're all hoping that when we're in retirement, all of these investments will eventually bring us some kind of income. So you have to manage those withdrawals, though. You have to do that in a way. I feel confident that you're hitting the market at the right time, and you're hitting these tools at the right time. You're also keeping in mind tax ramifications.
Taxes are a big discussion, and we talk about it every week. Of course, Lance and Melissa, our CPAs in our office, we're big into forward-thinking tax planning. Where to draw from, what investments in the most tax-efficient way possible. You know, we all worked hard for every dollar that we've saved, and we just don't want to give it to Uncle Sam unless you're very, very generous. And I find most don't want to be because they'll take it. Of course, they'll take it. But again, taxes drives a lot of the discussion. Just this past week, I had a couple that was in, and they drew off the wrong account, and it caused major capital gains tax implications. And recently, we also had somebody come in a couple years ago that the person they were working with thought it would be a great idea to do a very large IRA to Roth conversion, which we're big major advocates of Roth conversions. Fourth quarter, we're going to have these discussions, but only if it makes tax sense. Mm-hmm. And they went through with it 2 years ago. And because they converted so much and income showed up higher, it affected their Medicare and IRMA because there's a 2-year look back. It ended up costing them significant money. Those are the errors and the mistakes we want to help people avoid. And the problem these mistakes happen for many folks is they're not getting the attention they deserve. They're not getting the conversations. They're not getting the planning process. And that's really what our focus is. And we think it's extremely important. And I won't let it stop there. The other part was managing fees. You know, nothing is free. I don't expect to have anything free, but I think listeners should owe it to themselves to know what they're paying and what value they're getting, because I've said it before, when I ask folks on a weekly basis, what are they paying their guy or gal to manage their money? The answer I get 75 to 80% of the time is, that's a really good question, Larry. We have no idea. Which I find pretty amazing. You should know what you're paying and what value are you getting. And do you truly have a partner that's looking out for your interests, or, I hate to say it, are they looking out just for their own interests?
Sure, absolutely. And as we continue to talk about investment management principles, one of the things that we talk about pretty regularly here is behavioral principles and behavioral discipline. And this is the perfect time to talk about that because, you know, something major has happened in the economy, and that was a rate cut. There's been a lot of talk about inflation. People get emotional and they get panic stricken, and sometimes they make decisions that they shouldn't make, Kyle.
Yeah, emotional decision making is something that almost every single person has. Mm-hmm. And we just get so attached to the dollars that we've saved and worked our whole lives for that, I can't really blame anyone for getting emotional around that. But we need to make sure that we're not making any decisions based on that. And that's something that advisors can really help with is behavioral coaching. And one thing that we do to avoid ourselves from even doing that is just having a disciplined approach and strategy going into every relationship we have with our clients. And the way that we do that is we set that risk profile from the very beginning. We find out what was suitable, but then we stay within that risk profile, but we actively manage it. And when we do that, we're rebalancing at strategic times. When the portfolio gets out of balance by a certain variation, well, then that tells us that we need to rebalance. And we're not getting emotional from it. We're not going in there and seeing, oh, the S&P is up 2% today. We're gonna do this. And if we're on the vice versa, if it's down 5% today, we're gonna rebalance. We're doing it when the variation tells us that we need to. So that we're using technology to help us with that, because there's all these different asset classes, like we were talking about, that are acting independently, and we just need to make sure that we have a disciplined approach that helps us to not have any type of behavioral decisions going on. It's purely a strategic decision that we were aligned with at the beginning.
We've run through these principles pretty quickly, and they are really important for retirees when it comes to managing their investments. If you would like to sit down and talk more about investment management principles and the things that you should be looking out for and you should be doing to make sure that your investments are safe and are working for you in a positive way, give the folks at Haven Financial Group a call. Their number is 612-504-8400. If you're looking for a partner, someone who will work with you to make sure that your retirement is exactly what you want it to be, give the folks at Haven Financial Group a call. They would love to be your partner. It's 612-504-8400. Up next, take financial caution before transitioning into retirement. Are you just about to retire? Well, let's make sure that you've got all your ducks in a row. This is the Haven Financial Group Radio Show.